Welcome to the Deep Dive, the show where we take the densest stack of regulatory documents, research notes, and internal papers and distill them into the knowledge you need fast. Today we are focusing on financial stability, specifically how Australia is future-proofing its core financial institutions, the banks, the insurers, the super funds, against pretty much any disruption imaginable. Our mission today is to really crack open the regulatory architecture governing operational stability. This is coming directly from APRA, the Australian Prudential Regulation Authority.
That's right.
We're performing a deep dive into the Mandatory Resilience Rulebook, primarily focused on Prudential Standard CPS 230, operational risk management.
Which is the big one.
It really is. It's the major regulatory seismic event hitting the sector with full force in July 2025. And we'll also look at its absolute crucial prerequisite, CPS 234, information security. We need to quickly and thoroughly understand how these regulated entities must not just manage risk, but actually guarantee continuity in the face of, well, chaos.
And that difference, managing risk versus guaranteeing continuity, that's really the core idea here, isn't it? This isn't meant to be just a box-ticking exercise, designed just to minimize capital losses. It's really about ensuring the whole system keeps functioning.
Right.
What's fascinating here, I think, is the explicit regulatory shift and moving away from just focusing on internal controls towards mandating this kind of external resilience. APRA is essentially drawing a line in the sand. They're saying the services that protect depositors, policyholders, and superfund beneficiaries, well, they're just too essential to fail.
Regardless of the cost.
Exactly. Whether that failure is caused by a flood, a rogue IT update, or, a sophisticated cyber attack, it doesn't matter why it failed. It just can't fail beyond tolerance.
That is the perfect framing. And when you dig into the core standard, CPS 230, you see this entire resilience mandate is built on three pillars. The really interconnected pillars that form the architecture of the whole regulation. First, entities have got to establish these comprehensive frameworks for managing operational risks.
Yeah.
And that's like the broadest category of risk you can imagine.
It really is.
Second, they must develop and test business continuity plans, BCPs, designed specifically to maintain critical operations within predefined tolerance levels through any disruption.
Any disruption, that's key.
And third, they had to impose stringent control and oversight over their entire supply chain, making sure risks brought in by service providers are managed just as if they were internal risks.
That third one is massive in today's world of outsourcing.
Okay, let's start right at the beginning. Defining operational risk. We talk a lot about financial markets risk or credit risk, but operational risk, it always feels a bit more, slippery.
It does. It's the risk that kind of creeps up on you because it's just embedded in the day-to-day running of the business.
Yeah.
It really is the ultimate catch-all risk category, though. The standard gives a definition that's clean but pretty exhaustive. Operational risk is the risk resulting from inadequate or failed internal processes, systems, the actions or inactions of people, or external drivers and events.
Inadequate or failed.
Yeah.
That covers a lot. Both human error and systems just breaking down.
Precisely. That phrasing is powerful. And it's important to stress, APRA clarifies this risk is inherent in all products, activities, processes, and systems.
So you can't just wall it off.
Exactly. It's not something you can isolate in one department. It touches everything from how a loan application is processed all the way through to how the physical data centers are maintained.
So it's not just the big headline-grabbing stuff like a major data breach. It's also the sort of slow rot, the degradation of processes over time.
Absolutely. And APRA really went to great lengths here to remove any doubt about what entities must manage. The standard lists specific mandatory examples of operational risks. These have to be actively managed right across all the end-to-end processes. And this list, it really highlights just how complex this is.
Okay, so what's actually on that mandatory list? What specific risks are they calling out?
Well, it covers the compliance side first. So you've got legal risk, regulatory risk, and compliance risk itself. But crucially, they also mandate the management of conduct risks.
Conduct risk. That's interesting.
It really is fascinating because it forces institutions to recognize that things like poor employee behavior or cultural issues or, ethical lapses, these aren't just HR problems anymore. They are potential operational failures that can lead to massive financial damage, reputational harm, and even systemic issues.
That inclusion of conduct risk.
Yeah.
It really shows APRA is looking beyond just the technical failures. They're looking directly at the underlying corporate culture.
Absolutely. Then the list moves more into the technical and logistical stack. You've got technology risk, data risk, and finally, change management risk.
Change management risk.
Yeah.
Okay, why is that one so significant?
Well, think about it. Most major system failures, they don't happen when things are just running normally in steady state. They happen during periods of transition, like a major software upgrade, or migrating to a new cloud platform, or maybe restructuring the business. APRA mandates that the risk associated with change itself must be managed systematically. They recognize that change inherently introduces instability.
That makes a lot of sense.
Yeah.
Okay, so now we know what they have to manage. Let's nail down who. Who exactly falls under APRA's regulatory net here? It seems pretty broad across the Aussie financial sector.
It is very broad. The regulatory umbrella covers all APRA-regulated entities. So that includes authorized deposit-taking institutions, ADIs, your banks, building societies, credit unions, and importantly, that scope extends to include the Australian branch operations of foreign ADIs, too. It also applies to general insurers, life companies, including friendly societies and eligible foreign life insurance companies, or EFLCs, private health insurers regulated under the FEHAPS Act, and all registrable superannuation entity licensees, the RSE licensees.
Wow.
Essentially, yeah. Any entity holding public savings, insurance premiums, or retirement funds, they fall under this mandate.
That really does cover almost the entire financial ecosystem.
But there's another crucial aspect of the scope, isn't there? The bit dealing with corporate structure, the group requirement. Because modern financial groups, they rarely operate as single silos anymore. They often share services across multiple entities within a larger group, some regulated, some not.
Yes, and this is a potentially massive expansion of the standards reach in practice, where an APRA-regulated entity is the head of what's called a Level 2 or Level 3 group. The operational resilience requirements must be applied appropriately throughout the entire group, and compliance has to be achieved on a group basis. Okay, hold on. So let's say a bank owns a subsidiary. Maybe that subsidiary handles, I don't know, all its internal accounting and payroll, and that subsidiary itself isn't technically APRA regulated. Does that subsidiary now need to meet these operational resilience standards?
Precisely. That's exactly what it means. The moment that internal entity performs a service, even if it's a non-APRA regulated service like shared HR or data processing, if it supports the regulated entity's business, then it must adhere to the resilience standards set by the group head. APRA is just acknowledging a simple reality here.
Which is?
If the internal accounting system for the entire group fails, the regulated banking arm is obviously going to be severely impacted. It doesn't matter which specific corporate entity technically owns the broken system, it's an unavoidable obligation that recognizes how interconnected these operations really are.
Right. That's a significant complexity lift for internal governance, service agreements, all that stuff. Okay, before we move on from scope, we absolutely have to talk about the explicit link between CPS 230 and its sibling, CPS 234, information security. Because let's face it, in the modern world, operational failure very often is technology failure.
Oh, absolutely. The standard is crystal clear on this. It says an entity must maintain appropriate and sound information and IT capability that's needed to meet its requirements and support those critical operations we mentioned. And this is where APRA takes a direct shot at technical debt.
How so?
They require entities, as part of managing technology risks, to actively monitor the age and health of their information assets.
The age and health.
Yeah.
What does that practically mean for an institution? Does it mean ripping out old mainframes?
Not necessarily ripping them out tomorrow, but it means you can't just ignore legacy systems that are, creaking along but technically still functioning. APRA recognizes that older systems are inherently less secure, they're harder to integrate with new tech, and they tend to be more brittle under stress.
Right, they pose a higher risk of just falling over unexpectedly, which is the very definition of operational risk.
Exactly. So by requiring monitoring of their health, APRA is effectively forcing entities to prioritize investment in modernizing or, yes, eventually retiring these systems. And this naturally leads straight to the hard requirement. The entity must meet the information security requirements specifically outlined in Prudential Standard CPS 234. You simply cannot achieve operational resilience under 230 without first achieving cyber resilience under 234.
It really is a beautifully integrated structure when you look at it like that. They don't want to hear excuses like, oh, our payment system failed because of a known vulnerability that CPS 234 should have forced us to fix 5 years ago.
Precisely. The two standards are completely intertwined.
Okay, let's shift gears a bit and look at the practical application of this whole resilience mandate. If disaster strikes, a cyber attack, a flood, whatever, what services absolutely must keep running? This takes us to the concept of critical operations. This is what dictates where an entity has to focus its limited resources during a crisis.
That's right. Critical operations are basically the services whose failure causes the maximum harm, either to the public or to the financial system itself. The official definition is processes, whether they're run internally or outsourced to a service provider, which, if they get disrupted beyond specific tolerance levels, would have a material adverse impact.
Material adverse impact.
Yeah, and that impact can be on depositors, policyholders, super beneficiaries, customers generally, or even the entity's role in the wider financial system. It's a definition focused on the ultimate consequence of failure.
And APRA, being the regulator, they don't just leave it entirely up to the institutions to decide what's critical, do they?
No, definitely not. They mandate specific operations that must be classified as critical unless an entity can provide an exceptionally strong justification for why it isn't critical for them.
That makes sense. It sets a baseline.
These entity-specific mandates are vital. They standardize the resilience floor across the industry. So for authorized deposit-taking institutions, ADIs, the mandated list includes payments, deposit-taking and management, custody services, settlements, and clearing. These are really the functions that maintain liquidity and trust in the banking system. If payments freeze, the whole economy grinds to a halt very quickly.
Absolutely. And for insurers, what's non-negotiable for them?
For insurers, general, life, or private health, the big one is claims processing. That's mandated as critical. Think about it. The moment you pay your premium, the core promise the insurer makes is that when you need to make a claim, it will be processed. Failing to process claims means failing that fundamental duty.
The core promise is broken.
Exactly. And for RSE licensees, super funds, the critical operations are investment management and fund administration. They need to ensure retirement savings continue to be managed properly and member services like processing contributions or rollovers are maintained.
Okay, so those are the sector-specific mandates. Are there any that apply across the board?
Yes. For all regulated entities, they must classify customer inquiries as critical. And very importantly, all the supporting systems and infrastructure needed for any critical operation must also be classified as critical themselves.
Ah, so it's a chain reaction.
It creates a chain of criticality, yeah.
Sorry.
You can't claim your payment system is resilient if, say, the power supply to the data center it runs in or the core ledger software it depends on isn't also classified and managed as critical with the same level of rigor.
Got it. So once these critical operations are identified, the entity then has to set the boundaries for failure. This brings us to the formal, quantitative, legally binding tolerance levels. This feels like where the standard moves from qualitative risk management to hard, measurable performance metrics.
Absolutely. This is probably one of the most prescriptive parts of CPS 230. For every single critical operation, quantitative tolerance levels must be established, and crucially, they have to be formally approved by the board. These tolerances represent the maximum acceptable failure points. If you cross this boundary during a disruption, you are officially in breach of your operational resilience mandate, and you have to notify APRA immediately.
And the standard is very specific, isn't it? It specifies 3 distinct quantitative limits that have to be defined and measured for each critical operation. Let's break those down because they relate to really key concepts in continuity planning, things like RTO and RPO.
That's right. They are fundamental. The first one is the maximum period of time the entity would tolerate a disruption to that critical operation. This is what's commonly known in the business continuity world as the recovery time objective, or RTO.
RTO.
And this isn't, how long you hope recovery will take. It's the absolute hard deadline. For a really critical function, like, say, ATM services or a core trading platform, the RTO might be measured in minutes or maybe a few hours at most. For something less immediate, maybe a back office reporting system, it might be 24 or 48 hours. But if that RTO clock runs out during an incident, the disruption is officially outside tolerance.
Okay, so RTO covers the time dimension. What about data loss? Can you afford to lose transactions?
That's the second limit. The maximum extent of data loss the entity would accept from that disruption. This is the recovery point objective, or RPO.
RPO, got it. Yeah.
If a disruption happens, how far back in time can you afford to lose the data that was created or changed? If you run a high-volume payment system, for instance, your RPO probably needs to be near 0, maybe seconds or minutes, because losing transaction history is just unacceptable. For other functions, maybe you can tolerate losing an hour's worth of data. The RPO essentially dictates how frequently you need to back up your data and how robust that backup process needs to be.
Okay, RTO for time, RPO for data loss. And the third limit, this one seems important for defining what running in crisis mode actually looks like.
It is. The The third limit is the minimum service levels that must be maintained while operating under alternative arrangements. This addresses the reality that during a major crisis, you might not be running at 100% capacity. You might have to switch to manual processes, or use a scaled-down IT environment, or rely on a backup site. This tolerance level defines the minimum quality and volume of service that must still be delivered to stay within compliance. For example, if your standard payment processing time is 5 minutes, the tolerance might allow that to extend to, say, 30 minutes during alternative operations. But if it goes beyond 30 minutes, you failed to maintain the minimum service level, and you're outside tolerance again.
This is where it gets really interesting, though, potentially even revolutionary from a regulatory perspective. An entity might be tempted to set its own RTO for a critical system quite high, say 72 hours, just to make life easier for themselves internally. But APRA seems to have built in a mechanism to override that internal discretion, to enforce a higher standard if needed for public safety.
Yes, this is a really radical regulatory lever they've given themselves. APRA holds the power to require an entity to review and change its tolerance levels if the regulator identifies heightened risk or some material weakness in its operational resilience posture. And even more significantly, APRA may actually set the tolerance levels itself for an individual entity or potentially even for an entire class of entities.
Wow. So let's say APRA decides that, based on international best practice or maybe current cyber threat modeling, all major Australian banks must have an RTO of, say, 4 hours for their core payment processing systems. They can actually mandate that, regardless of what the bank's own internal risk committee might have decided.
Exactly. That's the power they have under paragraph 39. It fundamentally shifts the dynamic. It means that setting these resilience levels isn't just an internal risk management exercise managed solely by, the CFO or the COO trying to balance cost and risk. It becomes a mandatory public performance standard, potentially dictated directly by the regulator. It ensures that the baseline standard for consumer protection and overall systemic stability remains high, even if commercial pressures might tempt individual institutions to maybe underinvest in resilience.
It really does move APRA from being just a passive oversight body to potentially being an active setter of operational performance requirements. That's a big shift.
It's a very significant power.
Okay, we've established that operational resilience under CPS 230 is fundamentally reliant on good information security, which is governed by CPS 234. So let's pivot now and do a deeper dive into that cyber mandate, CPS 234. This is really the detailed blueprint for protecting the IT systems that underpin all those critical operations we just discussed.
That's right. And CPS 234 has actually been effective since July 2019, so it's provided the foundation for how APRA-regulated entities manage IT and cyber risk for a few years now. Its core objective is simple on the surface, but quite comprehensive in practice. Achieve resilience against information security incidents, including cyber attacks, by maintaining a security capability that actually matches the evolving threat landscape and the entity's specific vulnerabilities.
And the ultimate goal.
The goal is always to minimize the likelihood and the impact of any incident on the classic CIA triad of information security.
Right, the confidentiality, integrity, and availability triad. Can you quickly remind us how CPS 234 defines those three pillars in this context?
Sure. So confidentiality is all about ensuring that information assets are accessed only by authorized individuals or systems. This is crucial for protecting customer privacy and sensitive commercial data. Integrity means ensuring the completeness and accuracy of information assets and making sure they're protected from unauthorized modification or dilution. You need absolute trust that your data hasn't been tampered with. And finally, availability. This ensures that information assets are accessible and usable when they're required by the business or customers. And this links directly back to the RTO requirements in CPS 230 we just talked about.
Exactly. If your critical operation is down because the core data it needs is unavailable due to a cyber incident, you've effectively failed both standards simultaneously.
Precisely. The two are inextricably linked.
And under CPS 234, just like with 230, the board carries the ultimate responsibility for the entity's overall information security posture. But cybersecurity, as we all know, can feel like a bottomless pit for spending. How does an entity rationally decide how much security is actually enough security under this standard?
That crucial decision really hinges on asset classification. This is the core control mechanism within CPS 234. Entities are required to classify all their information assets, and that explicitly includes assets managed by third-party service providers based on two key factors: criticality and sensitivity. And these classifications have to reflect the potential impact, financial or non-financial, if something goes wrong with that asset, the impact on the entity itself, or in the interests of its customers or beneficiaries.
Okay, let's unpack those two factors, criticality and sensitivity. They're measuring different types of potential harm, aren't they?
They are. Criticality specifically measures the potential impact of a loss of availability. So if this particular asset goes down, how quickly does it cause a major problem? How quickly do we breach our RTO for a critical operation that depends on it? For example, if it's the core customer identity management service, that's likely extremely critical because almost everything else relies on it being available.
Right, and sensitivity.
Sensitivity measures the potential impact of a loss of confidentiality or integrity. This is more about data leakage, privacy breaches, or data corruption. Think about a database containing detailed medical history for a health insurer's policyholders, or maybe high-value proprietary investment strategy data for a superannuation fund. That kind of information is highly sensitive, and it's the combination assets that are both highly critical and highly sensitive that demand the absolute most stringent, usually the most expensive, and the most frequently tested security controls.
So you classify your assets based on potential harm, and then you have to apply appropriate controls. How does APRA define what's appropriate in this context? It must vary hugely.
It does vary. The standard requires that the controls implemented must be commensurate with, well, a few key factors. These include the specific vulnerabilities and threats relevant to the entity's environment, the criticality and sensitivity classification of the asset itself that we just discussed, the asset's stage in its life cycle. Newer systems might have different needs than legacy ones, and critically, the risks associated with exposure to what APRA calls untrusted environments.
That phrase, untrusted environments, feels particularly relevant today, doesn't it? Especially with remote work becoming so common and the massive shift toward using public cloud platforms.
It absolutely is. The standard is directly acknowledging modern IT reality with that phrase. If you have staff accessing highly sensitive client data from their home office over potentially insecure Wi-Fi networks, that's an untrusted environment. If your critical data resides in a multi-tenant public cloud environment where you don't fully control the underlying infrastructure stack, that's also potentially an untrusted environment. Your controls things like strong encryption everywhere, robust multi-factor authentication, network segmentation, zero-trust architectures. They have to be dynamically strong enough to manage that inherently increased risk profile.
And this security capability, it can't just be set up once and then forgotten about. It has to be tested systematically.
No, absolutely not static. A systematic testing program for controls is mandated, and the nature and frequency of that testing have to be scaled appropriately. It depends on factors like how rapidly the external threats are changing. If you're a major bank constantly targeted by state-sponsored actors, your testing cadence needs to be much higher. It also depends on the criticality and sensitivity of the assets being tested, the potential consequences of the control failure, and again, the risks from exposure to those untrusted environments. This testing mandate is what ensures the security measures actually keep pace with the constantly evolving attacker techniques and tools.
Okay, now let's tackle something really crucial and honestly often confusing for institutions. Incident management, and specifically the multiple notification windows to APRA. This is where the practical integration or potential friction between CPS 230 and CPS 234 becomes a real compliance headache.
It absolutely is a challenge. You essentially have 3 critical timeframes you need to keep straight and manage effectively during a crisis. Let's start with the first 2 because they actually share the same 72-hour notification window.
Okay, first up, the Information Security Incident Notification under CPS 234 itself.
Right. This is your classic cyber failure notification. Entities must notify APRA as soon as possible, but no later than 72 hours after becoming aware of an information security incident that materially affected or had the potential to materially affect the entity itself or the interests of its customers or beneficiaries. This is really about identifying a major security risk event, things like a confirmed system breach, maybe a successful ransomware deployment that's locked critical files, even if core services haven't totally collapsed yet. It's about the potential for harm.
Okay, 72 hours for a material cyber incident or potential incident. And the second 72-hour trigger, this one comes from the Operational Risk Standard CPS 230.
That's the General Operational Risk Incident Notification under CPS 230. Again, it's a 72-hour maximum window. But the trigger is slightly different. You notify within 72 hours if you become aware of an operational risk incident, which could be non-cyber, that is likely to have a material financial impact or a material impact on the entity's ability to maintain its critical operations. So this could cover things like a major internal process failure, maybe a significant legal ruling against the entity that impacts operations, or a catastrophic failure of a physical facility like a data center due to fire or flood. Importantly, if a major cyber incident is already reported under the CPS 234 notification rule, you don't generally need to double report the same incident under the CPS 230 rule.
Okay, so two distinct 72-hour triggers, one for material cyber incidents, CPS 234, and one for material operational incidents, which might be cyber or non-cyber, CPS 230. Got it. But then there is the third notification, the most urgent one, which kicks in only when a critical service actually collapses and breaches its tolerance level.
Yes, this is the fastest and in many ways the most consequential notification requirement. It's the 24-hour disruption notification under CPS 230, paragraph 42. If an entity suffers an actual disruption to a defined critical operation that goes outside tolerance, meaning you failed to recover within your board-approved RTO, or maybe you exceeded your acceptable data loss limit, RPO, then you must notify APRA as soon as possible, and absolutely no later than 24 hours after that tolerance breach occurred.
24 hours. That is an exceptionally tight deadline, especially considering the institution is likely already in full-blown crisis mode trying to fix the problem. Why the extreme speed requirement here?
The speed is deemed necessary because this specific notification confirms an actual failure of the resilience framework for a critical function. It's not just a risk event anymore, it's a confirmed systemic failure, even if localized initially. APRA needs immediate situational awareness to assess the potential for contagion to other institutions or broader systemic risk. When an RTO for a critical operation is breached, the entity has fundamentally failed its resilience mandate for that service. APRA needs real-time data: what caused it, what actions are being taken, what's the estimated recovery timeline, so they can determine if regulatory intervention is needed, or perhaps if other regulated entities relying on that failed service are now also at risk. That 24-hour rule demands incredible precision and process discipline, even under extreme operational pressure.
It certainly raises the stakes for having your incident response and communication plans incredibly well rehearsed.
Absolutely essential.
Okay, so transitioning from notifying APRA about failures to actually preparing to avoid or manage those failures. Let's look at the business continuity plan, the BCP. This is essentially the playbook for crisis management, isn't it? And APRA doesn't just want a plan, they demand that it's not only comprehensive, but also, importantly, credible.
Credibility is the absolute key word there. The standard CPS 230 paragraph 34 requires the entity to maintain a credible BCP. And that plan has to set out exactly how its critical operations will be maintained within those strict board-approved tolerance levels during any kind of disruption. It must explicitly include disaster recovery planning for all those critical information assets that we discussed under CPS 234. The overarching aim is threefold. Ensure the plan prevents major disruptions wherever possible, provide an adaptive mechanism to keep operating in crisis mode if prevention fails, and ensure prompt return to normal operations once the disruption is over.
So what are the fundamental components of the strategic and procedural elements that APRA actually mandates must be included within that BCP document?
Wow.
It needs to be more than just a list of phone numbers.
Oh, much more. The BCP has to be a full strategic blueprint for continuity. It starts with the basics: the register of critical operations and their associated approved tolerance levels, RTO, RPO, minimum service levels. That sets the performance targets. Then it must clearly document the specific triggers for activation. At what point does the normal management structure hand over control to the crisis management team? How is that decision made? It needs to detail the arrangements to rapidly direct resources, people, funds, technology to the recovery effort. And crucially, it must outline the specific step-by-step actions required to keep each critical operation running within its tolerance limits.
So the actual how-to guide for the crisis response.
Exactly. But it goes further. The BCP also requires a detailed assessment of execution risks, the resources needed, and all the dependencies. This means meticulously mapping out every single dependency for each critical operations continuity plan. Who are the key people needed? Do we have backups for them? What specific technology and infrastructure is required? Is it available at the recovery site? And critically, who are the service providers and other third parties that the operation relies upon? What are their recovery capabilities?
That dependency mapping sounds crucial. If your plan hinges on, say, 50 key people being available, the BCP needs to have verified that those people can actually execute their roles, perhaps from alternative locations or using different tools.
Precisely. And finally, the BCP must include a comprehensive communication strategy. How will the entity manage communications with internal staff, regulators, customers, the media, and other stakeholders during the crisis to support the execution of the plan and maintain confidence?
That emphasis on dependencies, especially service providers, connects the BCP directly back to the supply chain risk management pillar, which we'll definitely get to next. But of course, a plan sitting on a shelf, no matter how detailed, is potentially useless. The true test of any BCP is actually running through it, the testing program. APRA seems quite demanding here too.
The testing mandate is indeed highly demanding. Entities are required to maintain a systematic testing program that covers all critical operations over time. This program must include, at a minimum, an annual business continuity exercise.
An actual exercise, not just a theoretical desktop review.
Correct. A full dress rehearsal involving relevant teams, potentially activating backup systems, testing communication channels, not just talking about the plan, but actually trying to execute parts of it.
And the scenarios used for this testing. APRA uses the phrase severe but plausible. What exactly do they mean by that? It sounds like they want entities to test well beyond the typical fire alarm drill or a single server outage scenario.
Absolutely. Severe but plausible is designed to force institutions to model and prepare for low probability but high impact events. The kinds of things that could happen even if they haven't happened yet. They need to test scenarios like, perhaps, the sudden loss of a major co-location data center due to a regional infrastructure failure. Think about a massive power outage or a major fiber optic cable cut affecting an entire industrial zone where multiple entities might have infrastructure. They should test scenarios involving sophisticated cyber attacks, like maybe the successful deployment of a novel ransomware strain that specifically targets operational backups, making recovery much harder. Or maybe scenarios involving the targeted loss of key personnel. What happens if 30% of your critical IT security staff are suddenly unavailable due to a localized health issue or maybe unforeseen travel restrictions?
And the standard specifically requires testing against disruptions to material service providers. That must introduce incredible complexity, trying to realistically simulate the failure of a major cloud provider like AWS or Azure, or perhaps a core back-office processing outsourcer.
It is incredibly complex, but absolutely essential. The testing must include scenarios that specifically require the activation of contingency arrangements. This forces entities to prove that their Plan B actually works. They need to demonstrate that if their primary outsourcer for a critical function fails, the entity can successfully switch to a viable alternative provider, or perhaps bring the function back in-house temporarily without breaching the critical RTO for that service.
And APRA doesn't just rely on the entity's goodwill to pick sufficiently challenging scenarios for these tests. They've reserved the right to mandate their own test scenario, haven't they?
Yes, that's another critical regulatory check built into the standard. APRA may require the inclusion of an APRA-determined scenario in a business continuity exercise. This could be for a single entity if APRA has specific concerns, or potentially for an entire class of entities. For instance, if APRA identifies a emerging systemic vulnerability, maybe a specific new cyber threat vector targeting a common operating system used across the industry, or perhaps a geopolitical risk affecting a region where many entities outsource critical functions like call centers they can force the industry to test its preparedness for that exact scenario. It's a way to keep the industry's testing regime current and responsive to emerging threats that an individual entity focused on its own immediate risks might otherwise overlook or deprioritize.
Okay, so the tests are run, hopefully lessons are learned. How is the BCP then kept credible and actually useful over time? It can't just be updated once a year based on the calendar.
No, it needs continuous review and assurance. The standard mandates that the BCP must be updated at least annually or more frequently following any significant change in the entity structure, business mix, strategy, or overall risk profile. And crucially, it must be updated whenever shortcomings are identified during testing, or, for that matter, during an actual disruption. If a test proves that the planned RTO for claims processing is completely unrealistic with current resources, the BCP must be reviewed and remediated immediately, not just wait for the annual cycle.
And what role does the internal audit function play in ensuring the BCP remains credible? Are they just checking the documentation?
No, internal audit plays a much more substantial role. They serve as the board's independent assurance mechanism for business continuity. Internal audit must periodically review the BCP itself, the testing program, and the test results. Their objective is to provide assurance directly to the board that the BCP is, in fact, a credible plan, capable of maintaining critical operations within tolerance, and also that the testing procedures themselves are adequate and are being conducted satisfactorily. This ensures the board is receiving an objective, independent view of the entity's actual resilience capability, not just relying on a potentially optimistic self-assessment from the operational teams who developed the plan.
That independent assurance loop back to the board seems critical for governance.
It is. It closes the loop on accountability.
All right, let's move on to the third pillar, which you mentioned earlier is huge. The management of the supply chain, the service providers. In modern finance, outsourcing isn't just common, it's ubiquitous. But APRA's message here seems crystal clear. You can outsource the function, but you absolutely cannot outsource the accountability for resilience.
That is precisely the core principle underpinning this entire section. Paragraph 15 states it plainly. An entity must not rely on a service provider unless it can ensure that, even in doing so, it can continue to meet all its prudential obligations in full and that it can effectively manage all the associated risks. The liability for compliance for meeting those RTOs and RPOs for critical operations remains firmly and squarely with the regulated entity right from end to end. This means if a failure by one of your third-party providers causes you to breach your critical operation tolerance, you are still the one facing regulatory scrutiny and potential action from APRA, not necessarily the provider.
That's a heavy burden. So how does APRA define who qualifies as a material service provider? Surely not every single vendor needs this level of scrutiny.
No, materiality is defined by impact, as you'd expect. A provider is deemed material if either of two conditions are met. First, if the entity relies on that provider to undertake a critical operation, as defined earlier, or second, if reliance on that provider, even for a non-critical function, exposes the entity to material operational risk. If either of those conditions is met, the provider is material, and the entity must maintain a formal register of all these material providers, which has to be submitted to APRA annually.
And just like with critical operations, APRA mandates some minimum classifications here as well, basically forcing institutions to recognize certain core dependencies as inherently material.
Yes, they do, again, unless the entity can strongly justify otherwise. For ADIs, banks, this mandated list includes providers involved in credit assessment, funding and liquidity management, and mortgage brokerage. For insurers, it's providers handling underwriting, claims management, insurance brokerage, and reinsurance arrangements, basically the core functions that define the insurance promise. For RSE licensees, super funds, it includes providers doing fund administration, custodial services, investment management, and also arrangements with promoters or financial planners distributing the fund's products. And importantly, for all types of regulated entities, services like risk management functions, core technology services, and even internal audit, if outsourced, are generally deemed material by default. If you outsource your core IT platform or your entire risk management function, APRA demands you manage that relationship with the absolute utmost scrutiny.
Okay, so you've identified a material provider. Before any contract is signed or even significantly changed, what mandatory due diligence steps must the entity take?
The due diligence process before entering or materially modifying a material arrangement must be comprehensive. It needs to assess both the financial health and the non-financial risks associated with the provider. But APRA specifically calls out two areas that require rigorous assessment during this upfront due diligence. First, any risks related to the geographic location where the service is actually performed or where the provider is based. Second, risks related to the concentration of the service provider, essentially. Are you putting too many critical eggs into this one vendor's basket?
That geographic risk assessment seems incredibly relevant right now, with global supply chains and geopolitical instability. If a key service is being performed in a jurisdiction that's considered high risk, whether that risk is political, environmental, maybe regulatory instability, the entity has to demonstrate they understand that risk and have controls or contingency plans to manage that specific exposure.
That's exactly right. And the concentration risk applies in two ways. It applies internally, for instance, if one single IT outsourcer is handling all your critical payments processing, your custody systems, and your core banking platform. That's high internal concentration. But it also applies externally. What if that same outsourcer is also providing similar critical services to 80% of your main competitors in the Australian market? A failure at that single vendor then suddenly becomes a major systemic risk issue for the entire sector, not just your institution. APRA needs that broader concentration risk assess upfront as well.
Makes sense. Okay, now let's get into the contract itself. This is where APRA seems to be reaching right into the standard boilerplate language of commercial contracts, demanding very specific continuity clauses be included. What are the absolute must-haves in these formal, legally binding agreements with material providers?
There are several non-negotiable clauses required under paragraph 54. Obviously, the agreement needs to clearly specify things like service levels, the rights and responsibilities of each party, clear ownership of assets and data. That's standard contract hygiene. But regarding continuity and risk management, there are some standout mandatory provisions. First, liability for subcontractor failure. The agreement must explicitly state that the liability for any failure caused by a subcontractor, what APRA calls a fourth party, must remain the responsibility of the primary service provider you contracted with.
Ah, so that shields the regulated entity from having to potentially chase or sue an entity that's maybe 3 or 4 steps removed down the supply chain if something goes wrong.
Exactly. It simplifies the legal risk management significantly. The primary provider owns the performance of their own supply chain.
Okay, that makes sense. What about the ultimate unforeseen event, the classic force majeure clause? How does APRA handle that?
This is arguably the most revolutionary contractual requirement in the whole standard. Typically, as you know, a force majeure clause allows a party to suspend its obligations or even terminate a contract entirely due to major, unforeseen, uncontrollable circumstances like war, pandemics, natural disasters. APRA effectively turns this concept on its head for critical services. The contract with a material service provider must explicitly indicate which parts of the contract continue to operate even in the event of a declared force majeure.
Wait, hang on. So instead of force majeure being an exit ramp from obligations during a disaster, APRA requires it to be a blueprint for mandated minimum continuity.
Precisely. It forces the parties, the regulated entity, and the material provider to agree right up front in the contract negotiation that certain absolutely critical functions, perhaps reflecting those minimum service levels defined in the BCP, must be maintained by the provider, even if extraordinary circumstances apply that would normally trigger force majeure. This inevitably introduces a cost of continuity into the commercial negotiation. The service provider has to price in the resources, the redundancy, the planning required to keep that essential function running even under extreme duress. It fundamentally changes the risk allocation.
That is a massive change to standard commercial practice. And finally, on contracts, termination rights must also be robust.
Yes. The regulated entity must retain clear rights to terminate parts or the entirety of the arrangement, with defined exit processes. And specifically for RSC licensees, the superfunds, there's an extra layer of protection required. Their contracts must allow for termination if continuing the arrangement is deemed by the trustee to conflict with their overriding statutory duty to act in the best financial interests of the fund's beneficiaries. So, if the service provider starts posing an unacceptable risk to members' retirement funds, the contract has to provide a clear pathway for the trustee to sever that relationship promptly.
Okay, beyond the commercial terms between the entity and the provider, APRA itself needs regulatory visibility into these crucial third parties. The requirement for APRA to have the right to conduct an on-site visit sounds powerful in theory, but let's be practical. For a major Australian bank using a global hyperscale cloud provider like Microsoft Azure or Amazon Web Services, how is that mandate for an APRA on-site visit actually enforced? Are APRA staff really going to tour a data center in Ireland or Singapore?
That's a really crucial question about practical application. The standard, paragraph 55, absolutely mandates that the agreements must grant APRA the right to access documentation, data, information related to the service, and the right to conduct an on-site visit to the service provider's premises if needed. Now, for the megatech companies, the global cloud providers, the reality is, as you suggest, APRA is rarely, if ever, going to be conducting a physical inspection tour of a massive data center facility located in a foreign country. It's just not practical or efficient.
So how does it work in practice then?
Instead, the industry typically relies on carefully negotiated contractual mechanisms. These grant APRA, or more likely, an independent, appropriately qualified auditor appointed by the regulated entity but acceptable to APRA access to things like aggregated audit reports, like SOC2 Type 2 reports, compliance certifications against recognized standards like ISO 27001, security penetration test results, and other forms of documented assurance. The biggest global vendors usually have standardized contract addendums specifically for regulated financial institutions that are designed to provide this APRA level of visibility, primarily through these certified audits and shared assessment frameworks. However, it's important to remember that for smaller, perhaps more specialized material service providers, especially those based domestically, APRA absolutely retains the right to demand direct access, potentially including a physical visit if they have severe concerns about risk management practices. The key legal requirement is that the provider must agree contractually not to impede APRA's supervisory duties in any way.
Okay, that makes sense. The ultimate regulatory power is reserved in the contract, even if the day-to-day practical mechanism often relies on certified documentations and audits for the global giants. Let's briefly circle back to the complexity of managing fourth-party risk, the risk introduced by the subcontractors used by your primary material service providers. How does the standard address that?
Managing fourth-party risk effectively requires two linked actions under CPS 230. First, the regulated entity's own internal service provider management policy must explicitly address how it assesses and manages the risks associated with these fourth parties down the chain. Second, the formal, legally binding agreement with the primary material service provider must include a clause requiring that provider to notify the regulated entity of its use of any other material service providers, i.e., significant subcontractors, to deliver the contracted service. The regulated entity basically needs transparency. They need to know exactly which other links are in their chain of dependence so they can assess potential issues like concentration risk or geographic risk further down the line, even if they don't have a direct contractual relationship with that fourth party.
Visibility is key. And one final critical note on service providers. Offshoring. What are the specific requirements when services are performed outside Australia?
Offshoring triggers a specific preemptive notification requirement. Under paragraph 59B, APRA must be notified prior to the regulated entity entering into any material offshoring arrangement. That means any arrangement where a material service, as we defined it, is undertaken outside of Australia. Notification is also required when there's a significant change to an existing offshoring arrangement, especially if it involves relocating data or key personnel offshore to a different jurisdiction. This is all about jurisdictional transparency and risk assessment. APRA needs to understand where critical functions are being performed, where critical data is physically residing, and whether that location introduces any additional regulatory complexities or challenges for recovery in a crisis.
So no surprises for the regulator when it comes to offshore dependencies.
Exactly. Proactive notification is mandatory.
All right, we've covered the detailed standards for managing risk, ensuring business continuity, and overseeing vendors. Let's now confirm the accountability chain that's meant to make all of this actually work in practice. Who is ultimately responsible for ensuring an entity meets these demanding resilience standards?
Accountability rests firmly and unequivocally with the board of directors. Paragraphs 20 through 23 confirm the board is ultimately accountable for the effective oversight of operational risk management across the entire entity. This includes specifically approving the business continuity plan, BCP, approving those critical tolerance levels, RTOs, RPOs, minimum service levels we discussed, and approving the overarching service provider management policy. The board must also formally review the results of BCP testing exercises and the performance assessments of material service providers on a regular basis. This effectively makes operational resilience a mandatory, high-priority agenda item at the absolute highest level of corporate governance. It can't be delegated away entirely.
And the role of senior management, then, is primarily to execute the strategy set by the board and ensure the board is making decisions based on accurate and comprehensive information.
That's correct. Senior management is responsible for establishing clear roles and responsibilities for managing operational risk throughout the organization. Crucially, they must provide clear, comprehensive, and timely information to the board regarding the potential impacts on critical operations whenever the board is making significant strategic decisions. Things like acquiring a new business line, outsourcing a major function, or migrating core systems to a new technology platform. This ensures the board is fully aware of any potential resilience trade-offs or new risks being introduced as part of strategic change, allowing them to challenge management appropriately.
This robust accountability structure, running right up to the board, is presumably what gives APRA its enforcement teeth. So let's talk consequences. What happens if APRA conducts a review and identifies persistent material weaknesses in an entity's operational resilience capability? Say, the BCP tests repeatedly fail to meet tolerances or the due diligence and oversight of critical vendors is found to be consistently lax. What does APRA's enforcement toolkit actually look like under paragraph 19?
APRA has a range of clear escalating powers it can deploy if material weaknesses are identified. Initially, they might require the entity to undertake an independent review of its operational risk management framework, perhaps by a third-party expert firm, to get an objective assessment. They can also demand the entity develop and execute a comprehensive, time-bound remediation program to fix the identified weaknesses, with regular progress reporting back to APRA. More significantly, APRA can impose specific conditions directly onto the entity's license to operate, potentially restricting certain business activities until the resilience issues are demonstrably resolved.
Okay, those are significant operational and reputational impacts. But what about the direct financial levers APRA holds? Can they impose fines?
While direct fines are possible under other parts of the regulatory framework, the most significant financial lever specifically mentioned within CPS 230 relates to capital. APRA has the power to require the entity to hold additional regulatory capital. For RSC licensees, superfunds, this is explicitly linked to the SPS 114 standard, allowing APRA to mandate a specific operational risk financial requirement, ORFR, target amount that the fund must hold. For banks and insurers, it's an adjustment to their overall operational risk capital requirements.
Let's elaborate a bit on what that additional capital requirement actually means for a financial institution day to day. It might sound like just an internal bookkeeping adjustment to outsiders, but the real-world impact is potentially massive, isn't it?
Oh, it's massive. It is effectively a direct financial penalty, but structured as a regulatory capital imposition rather than a simple fine. When an ADI insurer or RSE licensee is forced by APRA to hold additional capital specifically against operational risk weaknesses, that capital becomes effectively quarantined on their balance sheet. It cannot be used for productive commercial purposes. It can't be used for making new loans, investing in growth initiatives, developing new products, or paying out higher dividends or distributions to shareholders or members.
So it directly hits their profitability and return on equity.
Immediately and directly. It acts as an immediate drag on the institution's profitability and its financial efficiency ratios. The moment APRA imposes this additional capital requirement, the entity's senior management and board have an incredibly powerful, non-discretionary financial incentive to fix the underlying operational weakness as quickly as humanly possible. Because every single day they are forced to hold that extra, unproductive, quarantined capital, they are losing commercial opportunities and potentially falling behind competitors. It very effectively turns operational failure or inadequate resilience into an immediate, measurable, and ongoing financial cost that gets executive attention like nothing else.
It certainly reframes the discussion internally, shifting it from just the cost of compliance towards the much larger potential cost of non-compliance and subsequent remediation. Okay, before we wrap up this deep dive, let's just quickly revisit the critical timeline for these standards. When does all this bite?
The primary standard we focused on, CPS 230 Operational Risk Management, officially commenced and it became enforceable on July 1st, 2025. So this is very much a current and urgent focus for all regulated entities right now. They are expected to be compliant immediately with the core requirements. However, APRA did include a small transitional arrangement specifically for legacy service provider contracts. Those pre-existing contracts, the ones that were already signed and in effect before July 1st, 2025, those contracts have a grace period. They need to be updated to include all the mandatory clauses we discussed, like the modified force majeure continuity requirement, the APRA access rights, the fourth-party liability clauses by the earlier of either their next scheduled renewal date or final deadline of July 1st, 2026. But for any new material service provider arrangements entered into from July 1st, 2025 onwards, those specific contractual clauses are mandatory from day one.
Right, so for virtually all regulated entities, the period from mid-2024 through to mid-2026 is absolutely dominated by a comprehensive overhaul of their operational risk frameworks, intensifying their BCP testing regimes to meet the severe but plausible standard, and undertaking massive legal and commercial efforts to renegotiate and rewrite potentially hundreds or even thousands of existing vendor contracts to meet these new demanding requirements. It's a huge undertaking.
It is arguably one of the most significant operational uplifts the Australian financial sector has faced in recent years. #outro.
Well, this deep dive into APRA's CPS 230 and its partner CPS 234 certainly reveals that the regulator has implemented an incredibly robust and highly integrated framework for operational resilience. It's clearly built on those three non-negotiable pillars we discussed. 1, managing the full broad spectrum of operational and cyber risks. 2, maintaining comprehensive, frequently tested business continuity plans benchmarked against hard board-approved tolerance limits. And 3, extending effective regulatory oversight and accountability across the entire third and even fourth-party supply chain. A key theme is that information security under CPS 234 is no longer a siloed technical function. It's absolutely foundational to achieving the broader operational stability mandated by CPS 230.
I think the overarching takeaway, the fundamental shift here, is moving the focus from primarily minimizing the institution's own financial losses from disruptions towards guaranteeing the performance and continuity of essential services to the public. This regulation fundamentally mandates continuous service delivery for critical functions, regardless of the underlying cause of the disruption, be it flood, fire, pandemic, technical failure, or sophisticated cyber attack. And the absolutely critical point, which we've touched on several times, is that the regulated financial institution remains fully accountable for delivering that guarantee, even if the ultimate point of failure lies buried deep within an outsourced provider's infrastructure, processes, or even their subcontractors. They own the end-to-end risk.
It sets an incredibly high bar for operational continuity, risk management discipline, and particularly for contractual governance over vendors. Now, as we wrap up, here is a final provocative thought for you, our listeners, to consider as you reflect on these demanding mandates. Given that APRA now requires formal service provider agreements to specify precisely which parts of a contract must continue to operate, even in the event of a force majeure, effectively preventing the service provider from simply walking away from critical obligations during a major crisis. How does this new mandate for enforced continuous performance fundamentally reshape the underlying economics and risk profile of outsourcing in the financial sector? And perhaps more pointedly, how much higher a price must the regulated entities now expect to pay their key technology and service vendors to get them to accept the significant legal and financial burden of providing that guaranteed continuity under duress? That negotiation and the resulting cost has certainly changed the risk calculus for everyone involved.
It absolutely has. It effectively converts what was often treated as an optional, commercially negotiated risk assumption into a mandatory, high-stakes, and potentially very expensive investment in demonstrable resilience.
A fascinating point to ponder. We'll leave you with that thought. Thank you for diving deep with us today.